all else equal, oil prices and commodity inflation would be higher. All else equal, bond yields would be higher. Now we're moving to contain bond yields, which is probably even more inflationary for commodities, but doesn't necessarily negatively impact bond yields. Containing bond yields is also going to be good for nominal GDP growth, and for financing for things like AI, et cetera. So it's probably good for those things. And so when I sort of like blend all of this and when I blend all of this together, I think the war ends up being positive for stocks in dollar terms and negative for stocks in gold terms. Basically a continuation of what we've seen. Well, it's overall bullish gold because the only way the U.S. is able to stop itself from a debt spiral, and with it the West more broadly, is by keeping real rates negative. That's what we're talking about here ultimately. Today's move is ultimately just the latest down payment in moving towards significantly negative real interest rates. And what I mean significantly? Significantly. And that's good for gold. In terms of the war, the price of gold peaked right, I think, on the day that Warsh was appointed or was announced by Trump, right? I think right at the end of January, and then sold off with the war. I think gold was acting through this war like a reserve is supposed to. I think it's actually interesting, right? Historically, when gold was not part of the system, gold got bid on wars. People are like, oh, I need to hedge something bad. Gold's now part of the system again. It's a bigger share of FX reserves than dollars are, than treasuries are. And so
because it's rallied so much,
the S&P is at 7,800. Share count's down. How do we count the S&P?
Yeah.
Right? Gold's price rallying so much to make it the biggest part of reserves is the whole point. That's the whole point. Right? In the same way that you don't say, hey, I have this many shares of S&P in your 401k. What do you say? What's my 401k is worth this in dollars?
True.
So gold's back in the system. And so when you're back in the system as a reserve, when it rains, you got to sell. And so you can see gold was sold. Treasury bonds were sold. Both were sold by some parties. Now, China, who is supposed to be being choked out of oil, and, their economy falling apart, did sort of the old take and bid it. Hey, gold's down. Great. Give me 10 tons this month. Next month, 12 tons. Next month, 14 tons. Next month, 19 tons. Next month, 26 tons. Just waving it in. So, and not everybody, but yeah, central banks overall sold gold. A bunch of central banks sold gold. Central banks bought by just like a little bit on a net basis in the calendar first quarter. But in the calendar second quarter, gold buying went back to basically all-time highs.
Gold is increasingly being discussed as more than just a defensive asset for times of crisis. Central banks across many countries have kept expanding their gold reserves, reducing how much they depend on foreign currencies and government bonds. Unlike financial assets tied to the banking system, physical gold can be traded without needing another nation's permission or financial infrastructure. Recent years have brought record levels of official sector gold purchases, reinforcing confidence in the metal's long-term strategic value. The trend suggests governments are preparing for a future where reserve diversification becomes essential, especially as trust in traditional monetary arrangements comes under growing pressure worldwide.
By central banks. So I think that's why gold got sold off was exactly people sold it because they needed dollars or they needed oil. And that also is a support for gold's now back in the system. And by the way, it worked. Notice nobody needed to do gold swap lines. Nobody needed to intervene in the yen because people were selling too much gold. It just worked. And they didn't need Bessent's permission to sell gold. Like U.S. allies need reportedly permission to sell treasury. You don't need the banking pipelines to sell your gold. Unlike, look, I like Bitcoin long term, but Bessent's been talking about controlling the pipelines and the on and off ramps to this. And purists know you don't need on and off ramps for Bitcoin. But I think probably at sovereign levels, that's a bit much. But the gold is pretty easy to see, and you don't need anybody's permission. So gold did what it was supposed to do in the war, if gold is moving back into the system, if gold is now a more important FX reserve than treasuries are, which it is. That's just a fact now. And I think they're only going to get more important going forward with all the actions the U.S. are taking, which are effectively communicating that treasuries are only good for certain things if we say so at certain times. And oh, by the way, we're going to be managing the yield curve to erode the real value of your treasury holdings. If I'm a sovereign, I'm just saying, all right, fine, I'm done. I'll buy whatever, just gold. My understanding was that the United States did not let the Europeans know, which apparently was a violation of international protocol. Basically, Besant came out and sold euro. We've got, I think it was 11 billion euro in reserves on our balance sheet, and he sold those to buy yen. Famously with the stylized Instagram, sell yen thing. And I think the reason he did the stylized, thing was essentially to try to get a bunch of friends in the hedge fund community to front run him and do the heavy lifting for him. Hey, I'm going to sell 11 billion in euro. And if you front run it, you can, he could get a lot more bang for his buck. And I think that's probably why we saw this little stylized Instagram thing, to let all these guys know before he actually did it. And that's fine. It bounced back pretty quickly, right? I haven't checked levels, but it's already retraced over half of that full intervention, if I'm not mistaken. And then he talked about these FEMA swap lines. I don't know enough to know about whether they're in the true spirit or not. I would probably take Nick Timmerhouse's word on it. He knows that. Besant was honked off with the nasty gram about Nick. And I think we are getting into, this sort of infighting between these two gentlemen, or, Besant saying that, I think smacks of the desperation that Besant feels, which is, at the end of the day, the Fed's job is one thing: finance the U.S. government. And the Fed likes to play all coy and we're independent and blah, 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 blah. At the end of the day, that's their job. And the problem is they never thought it would happen again. Happened in World War II. It's happening again. And I don't think the Fed likes that, or certain interests around the Fed certainly don't like that. But that's their job.
One of the stronger arguments here is that the United States is facing mounting pressure from rapidly rising interest payments on its national debt. If borrowing costs keep climbing faster than government revenue, policymakers may eventually turn to extraordinary solutions. Some analysts believe future strategies could involve keeping interest rates artificially low while letting inflation quietly erode the real value of outstanding debt. That kind of approach could stimulate growth and corporate profits in the short run, but it would also weaken purchasing power for savers. Critics warn that trade-off could carry lasting consequences for households living on fixed incomes.
Now I'm Besant, and I can buy back everything in cash beyond probably 5 years. Then I roll out the Clarity Act and stick the rest of it into stablecoins. And then my last little special surprise for everybody is, hey, a stablecoin T-bill doesn't yield 3.5. Yields 60 basis points. Have a good day. Done. Now, who wins, who loses? Treasury holders get killed. Inflation goes nuts. Wages go nuts. Nominal GDP growth goes nuts. Great. That's what we need. Who holds all the bonds? Banks, who got bailed out and never paid for it, really. And boomers, who are the richest generation in history and are consuming 80% of the budget and not paying for it. You just paid for it, guys. Thank you for your donation. Thank you for your service. Done. It's that easy. Now, politically, you're going to have inflation. You're going to lose the midterms. But it's easy mechanical fix. It's like the easiest thing in the world. Stock market goes nuts, by the way. Nuts. Dow probably goes from 50,000 to 100,000. Corporate earnings go nuts. Hiring goes nuts. The debt's the problem.
How do you think inflation goes in this Luke Gromen scenario?
10, 15% for a couple of years. So if you go to the Federal Reserve manual for financial accounting manual, for Federal Reserve banks, it's a public document. It's published at least once a year. Section 2.10 says that the gold is held at 42. The Treasury Secretary at his sole discretion can instruct the Fed to revalue it. It's basically, and by revaluing it from 42 to whatever that market price is, which you could get it up there. I could get it up there, I think. Especially if the Chinese are on board, which I think they would be. And that mechanically creates a deposit of cash into the Treasury General account at the Fed. It's basically just debit gold, credit cash, right? So it's, you're increasing the value from 42 to 20,000. You have to have an offsetting a journal entry. It's 261 million ounces times 4,000. Every $4,000 is roughly $1 trillion. And so 20,000 up from here from 42. That's basically 5 fours. So 5 fours. So 5 trillion, right? If every 4,000 is $1 trillion, 5 of those is 5 trillion. This just mechanically gets deposited into the TGA. That might be one of their only ways out of this, actually. Now that we're into this period where your interest and interest-like obligations are growing nearly twice your receipts, and your receipts are inflated by AI, which isn't going to keep bubbling forever. Look, we are now at the point where there are no pleasant ways out of this. We are now into dancing along the edge of a debt spiral, and it's the entire West. And, China ain't going to end up great in that outcome either. So once you get to here, the Overton window of possibilities starts to blow out immensely, right? In terms of policy options. This is a policy option, and it would work. I mean, inflation's in the cake. Like, don't kid yourself. We're going to hear every apologist on X telling us this isn't money printing and it's not inflationary, and it's bullshit. You're taking long end bonds and you're moving them to the front end and you're going to cut rates. That's inflationary. You are money financing stuff. Stop. Don't lie to people. It's inflationary. No, I would be honest, actually. I would do the FDR thing. I would sit down with the American people like a fireside chat, and I would say, listen, something that is extraordinary is going to happen over the next month. And the reason it's happening is because your leaders have been lying to you for 80 years, 90 years. They told you could have free stuff and never pay the cost. And that's a lie. We all know you're all adults. There's no such thing as free stuff forever. And I'd say what I said to you. The 70 million baby boomers were born from 1946 to 64. And yet your leaders pretended like they were never going to turn 65. They were always more interested in themselves than in doing what is best for the country. And as a result of their lack of courage, followed by the lack of explanation and courage around Medicare, Medicaid, the lack of courage around Vietnam, the lack of courage around the Iraq War, the lack of courage around the bailouts and how they were handled politically, the lack of courage around COVID, which we're seeing in a big way. Those people lie to you. I'm not going to need a lot of help convincing people that their government has been lying to them badly for 90 years. Here's what's going to happen, American people, as a result of the lies your government has told you for the last 90 years. We're going to get rid of the debt. Doing so is going to be inflationary. The effects of this are going to be very inflationary. However, the inflation is not going to be evenly distributed. It is going to be most painful to those areas of the U.S. economy and world that benefited most from this arrangement: Washington, Wall Street, and retirees. And it is going to be least painful for those who were hurt most by this arrangement: the working class, the middle class, wages. And then I stand aside because I don't want to run again. Why would I ever run again? I wouldn't want to be in that cesspool for more than 5 minutes if I could avoid it.
Luke, in that environment, don't long end yields rise a lot?
No, because the Fed's going to buy them all.
Okay.
There are no long end yields. It's not a market.
No long end yields.
Look, because, oh, by the way, the gold holders, I said this to you at the end of, maybe not last time, but 2 times ago, where you asked me what yield would you buy 10 years at? And I said, no yield. It's not about the yield. It's about the price of the dollar. At $20,000 gold, I would buy 10-year paper at
Right. Yeah, I remember that.
And it's fascinating. We're watching in real time. The more the yuan collapses against gold, and it has collapsed. Everyone's been waiting for it to collapse against the dollar. The yuan's collapsed against gold. What's happened to Chinese yields? Down, 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 down. Mm-hmm. At the right price of gold, you're basically going to have a gold collateralized de facto treasury market. And in a gold collateralized bond, and Judy Shelton's work has done a lot of groundwork around this, and 2% interest rates for the long term, if it's gold collateralized, maybe 3%. That's the part people are missing. Gold at a high enough rate doesn't destroy the treasury market; it collateralizes it. Now, on a real value, yeah, it's a restructuring, no question. But these people need to be restructured. It's an insolvent market.
And there's enough gold at $20,000 gold. There's enough gold to back the treasury market.
No. I think the market's what, 30 trillion today.
Yeah,
$20,000 gold is going to be worth officially 5 trillion, right? So but if you look at the treasury market, and I don't know these now, I want to say the 5 trillion probably takes you, it's probably 100% of everything over at least 7 years and maybe over 5 years. And you can buy it all back. And then, if you want to reissue it bills, you want to resize that, however you want to do that, you can certainly do that. But it's a paradox. You would think that with inflation ripping and gold at 20,000, gold at 20,000, inflation ripping in the short run, it would be terrible, but you're basically restructuring it on the other side. You're going to have lower yields.
If inflation became the primary tool for reducing debt burdens, the economic fallout wouldn't land evenly. Borrowers could actually benefit since debt gets easier to repay in real terms, while investors holding long-term bonds could see their real returns decline. Workers might see wages rise, though higher living costs could easily offset those gains. Meanwhile, countries like China have kept expanding their gold reserves, feeding speculation that future financial influence may depend less on treasury holdings and more on alternative reserve assets. These shifting strategies point to an increasingly competitive race to build financial resilience ahead of the next major economic transformation.
What about, though, when debt grows faster than gold supply, as has happened before?
That's just a price issue, right? Remember what you said before? Gold. So
you need another revaluation, another revaluation of gold higher, aka another dollar devaluation.
You would need some sort of agreement where the problem with gold is when you peg it to a currency.
Okay, so you're not suggesting a peg.
No, not at all.
Okay, got it.
No.
Yeah, I'm with you.
No. What you would do is essentially you're going to settle in gold now, right? And I think that you would probably have some sort of agreement where you would say, look, if you're going to peg anything to anything, you're going to peg gold to oil at 1,000 barrels an ounce. And oil doesn't move a lot. Mm-hmm. Right? So, or say 500 for easy math. $40,000 gold, $800 or $80 oil, excuse me. And that you could do something like that. You could, you don't have to do this through Besant. You could do this through agreement between China, Russia, and the Arabs. Hey, we're going to sit down. We're going to do a conference, and from now on, oil or gold is 500 barrels for an ounce of gold, and we will have devalued oil, which backed the dollar for 50 years de facto, against gold, which backed the dollar for pretty much the rest of American history. And in so doing, we will have created an economic market-based incentive. Now, if America wants to have a lot of oil for national security reasons, great. We all know we need $70, $80. Maybe we need $60, right? We can't do less than 60. Okay, 60, 500, boom, 30,000. You got to have $30,000 gold. So the whole exorbitant privilege goes away. We can't print dollars for oil anymore. That's fine. The Chinese, they want cheap oil because they don't have any oil. Not enough, certainly, right? As we've all been, they don't have nearly enough oil relative to what they consume. great. They need cheap oil. That's fine. But if you have cheap oil, then you have cheap gold. And so cheap gold in yuan, expensive gold in dollar, what's going to happen to the currency? Yuan's going to strengthen a lot against the dollar. China's ability to be mercantilist will also be hamstrung or limited by that arrangement, by pegging gold or oil to gold. The Europeans, same thing. Hey, we don't have really oil resources, and so we need to incentivize EV. So we want relatively expensive oil. So EVs make sense. Okay, 100 euro, boom, 50,000 euro gold. I think that is ultimately where we'll end up. I don't know if we'll end up there without a war or not, or if we'll end up there. But that's another way you could do it. And then if we did it that way, then boom, then you can revalue the gold using that. That probably requires some sort of international agreement. Probably just between the U.S. and China and a couple of the Arab countries. It would be more than enough. Strong arm everybody else. Tucker asked him about it. You can find that quote on online and I think there's a Treasury transcript of it as well. Last April, when he was on with Tucker Carlson, April of 2025, and he said it. And I think Tucker asked him about gold, and Bessent said, "Hey, look, I would probably be considered a gold bug when I ran my fund." And that's when he laid out that math or those quotes.
Is that philosophy, do you think, going to be affecting his views? Like, is he going to be doing the Luke Gromen playbook, or even 1% of the Luke Gromen playbook?
I hope so. It would be the best thing for America. People say gold's anti-American, yet the best parts of the best times in this country have been when we've been, we had a neutral reserve asset. And
when were the best times in the country?
Oh, I would say from Hamiltonian through 1971.
Mm-hmm. Okay.
And critically, he updated his thoughts, in my opinion, as it relates to that, which is in June of this year. He gave a speech at the New York Economic Club about Hamiltonian economics. And in case anybody thought he was speaking out of turn, he wrote an op-ed in the Wall Street Journal that same day. It said, Trump's economic statecraft is based on Hamiltonian economics. What's Hamiltonian economics? Neutral reserve asset, high tariffs, tax foreigners to pay for America rather than tax Americans to pay for foreigners. Trump in early 2025 said, I want to take us back to when America was wealthier and more powerful than ever, 1870 to 1913. We were taxing foreigners to pay for Americans rather than taxing Americans to pay for foreigners. At Davos earlier this year, U.S. Trade Representative Jamison Greer came out and gave a speech about Hamiltonian economics, got lost in the shuffle of Carney and his elbows up and the world order's over and all this crap. And he said, listen, we're moving back to Hamiltonian economics. And he specifically called out that Keynes's neutral reserve asset proposal at Bretton Woods was a better idea. So I think Bessent is absolutely on board. And you could say, okay, well, is some of what we're seeing today, could this all be sort of a 5D chess move in that direction? Possibly. He's a very smart man. It's very possible.